You mentioned that the amount you're trying to raise is so intricately linked to the actual valuation, right? In some ways, your raise amount is an output of the valuation. What is the biggest determinant of a company's valuation during a fundraise?
So it's a simple equation. Money raised divided by post money equals dilution. And so those three variables are interconnected. I would almost say that the two variables that are most influential, and one's controlled by the market and one's controlled by the founder. The market controls dilution, the founder controls how much money to raise. So we talked about that a second ago about the spectrum. So this spectrum allows you to define maybe a range of how much you could raise, but the market is determining how much dilution is typical for that range. So it's rare that a founder who's starting from zero can raise 200 million in one go. It's just rare. So the dilution there is infinite because nobody's going to ever give you that. And if you're raising very small amount of money, the probability you get is pretty 100%, like $10, probably somebody can give it to you. It's very easy. So you can almost get it for, very little, right? So that's the spectrum, but market isn't just about probabilities of getting funding. Market more specifically is about what level of dilution an investor giving you, or what level of ownership, which is, the equivalent of dilution, what level of ownership an investor who's giving you money is going to expect for the capital they're giving you. So an example of that would be in the 2020s, early 2020s, during COVID, when a lot of companies were getting funded, there was a lot of competition for those companies because the public markets were very hot. So a lot of people went into the private markets. It meant there was a lot of competition. A lot of competition means that investors have to offer more favorable terms. More favorable terms means less dilution. So that means that the valuation is a function of less dilution, right? And therefore, the post money of your company is going to be higher because even if you fixed the amount of money you're raising, the market is determining that for that amount of money, they can take less, or they should take less equity. And so in a highly uncompetitive market, or one where there's a scarcity of capital, that flips, right? So the market says, well, look, you want that amount of money? There isn't a lot of money around, so it's going to be a little bit more expensive. And so I think that's probably the biggest mystery unpacked about evaluation of companies, is that it isn't some sort of arbitrary thing. It's not something you can calculate through a traditional method that you learn in school. It's a function of the competitiveness of capital at that stage you're in the geography that you're in, and then that married with how much money you're raising. And if your range of money is too much or too little, that will affect the likelihood of you getting that percentage at all, right? Because it'll go from an acceptable tight range to zero because nobody wants to give you money at that valuation. So it's an interesting sort of like step function. It's like, here's this curve of probability, and then zero and 100% on both ends, depending on, how much you're asking for and what your expectations are.